You and your landlord probably make similar money. Maybe you even make more than he does. But at the end of the year, when both of you sit down to file taxes, something really weird happens. You write a check to the IRS. He doesn't. And I'm not talking about some offshore account or some shady scheme. I'm talking about something sitting right there in the IRS tax code. Something your landlord's accountant knows about. Something your HR department has never once mentioned to you. There are 4 tax loopholes the US government has literally written into the law, specifically for real estate owners. And if you're a regular W-2 employee, none of them apply to you. By the end of this video, you're going to understand exactly how this works. And more importantly, what you can actually do about it. Let's get into it. Real quick. If you saw my last video, you already know that the IRS has basically 2 tax systems running at the same time. One for people who earn money by working. One for people who earn money by owning things. Warren Buffett, paying 18% while his secretary pays 36%. That's not a glitch. That's the system doing exactly what it was designed to do. Real estate is where this gets even more aggressive. Because when Congress sits down to write tax law, they consistently, every single time, give property owners benefits that wage earners simply do not get. And in July of 2025, they did it again. A new law called the One Big Beautiful Bill Act was signed on July the 4th, 2025. And buried inside that 870-page document are provisions that permanently change the tax math for landlords across America. We're going to break down 4 of those provisions today, in plain English, with real numbers. All right. Loophole number 1, and this one is wild because it's completely invisible to most people. It's called depreciation, and here's the simple version. When you own a rental property, the IRS says, okay, this building is going to wear out over time, so we're going to let you deduct a portion of its value every single year. Even if the property is actually going up in value in the real world. Let me give you a real number example. Say you buy a rental property for $300,000. The land is worth about $50,000 of that. So the depreciable value, the building itself, is $250,000. Now the IRS says residential rental property depreciates over 27.5 years. That's their rule. IRS Publication 527. So you take $250,000 and divide it by 27.5. That gives you $9,090 every single year for 27.5 years. You can deduct $9,090 from your taxable income, even if your tenant is paying you rent. Even if the property went up in value by $30,000 that year, you still get to claim a $9,090 loss on paper. Now think about what that means in real money. If you're in the 24% tax bracket, which is where a lot of middle-class Americans land, that $9,090 deduction saves you about $2,180 in taxes every year. On a property that's probably appreciating, you're getting paid to own something that's going up in value, while simultaneously telling the IRS it's losing value. And it's all completely legal. It's right there in the tax code. Now here's where the 2025 law change made this even more powerful. Before July 2025, there was a rule called bonus depreciation. It used to let landlords and businesses front-load depreciation. Instead of spreading it over 27.5 years, you could take a big chunk of it in year 1 on certain property improvements and components. But Congress was slowly killing it. Under the old rules, bonus depreciation was going to be 40% in 2025, then drop to 20% in 2026, and completely disappear by 2027. Then the One Big Beautiful Bill Act happened, and Congress permanently restored 100% bonus depreciation for qualifying assets acquired after January 19, 2025, permanently. Not temporarily, permanently. This means a landlord who does what's called a cost segregation study, basically a detailed breakdown of their property's components, can reclassify things like appliances, flooring, wiring, and fixtures into 5 to 15-year categories and immediately deduct their full cost in year 1. A $500,000 rental property after a cost segregation study could generate $80,000 to $120,000 in first-year deductions. Deductions that a regular employee sitting at a desk has absolutely zero access to. Okay, loophole number 2. This one is how wealthy real estate investors grow from 1 property to 10 properties to 50, while barely ever writing a check to the IRS. It's called the 1031 exchange, named after Section 1031 of the Internal Revenue Code. Here's how it works. Normally, when you sell an investment property for a profit, you owe capital gains tax on that profit. Long-term capital gains rates are 15% to 20% depending on your income. Plus, there can be state taxes on top of that. So if you bought a property for $200,000, held it for 10 years, and sold it for $400,000, that $200,000 gain could cost you $30,000 to $40,000 in federal taxes alone. Minimum. The 1031 exchange says, hold on, don't pay that. Roll those proceeds into another investment property instead, and we'll let you defer that entire tax bill indefinitely. The rules are strict. You have 45 days after selling to identify your replacement property, and you have 180 days to actually close on it. You also need a qualified intermediary, a third party who holds the money during the process. You can't touch the cash yourself. But if you do it right, that $30,000 to $40,000 tax bill disappears, rolled forward into the next property. And here's the kicker. If you keep doing 1031 exchanges for the rest of your life, buying, selling, rolling into bigger and bigger properties, and you pass those assets to your heirs when you die, your heirs get what's called a stepped-up cost basis, meaning the original gains essentially vanish. The entire tax liability that built up over decades, gone. This is not a rumor. This is IRS-confirmed tax law, and it is one of the single most powerful wealth transfer tools in existence. Here's a real-world example that was documented. An investor bought a Dallas duplex in 2008 for $250,000. They claimed $91,000 in depreciation over the years, sold in 2024 for $580,000. Under normal tax rules, they would have owed $89,050 in federal taxes, capital gains plus depreciation recapture. They did a 1031 exchange into a $650,000 property in Arizona. Tax bill, zero. For now, deferred completely. That $89,050 stays in their pocket, compounding in their next investment. This is the one that makes people the most frustrated when they hear it, because it sounds like it shouldn't be legal. It's about using real estate losses that don't even involve actually losing any money, to reduce taxes on income you really did earn. Here's the setup. Remember that depreciation we talked about? Your landlord claims $9,090 a year in depreciation on their $300,000 property. That's a paper loss. They didn't spend $9,090. The building didn't lose $9,090 in value. It's a theoretical accounting deduction. But what if that paper loss is bigger than their actual rental income? Let's say they collect $18,000 a year in rent. They have $9,000 in actual expenses, mortgage interest, repairs, insurance, and $9,090 in depreciation. On paper, they made $18,000 but spent $18,090. So on paper, they lost $90. The IRS says, okay, you can use that rental loss to offset other income. Now there are income limits here. If your adjusted gross income is under $100,000, you can deduct up to $25,000 in passive rental losses against your regular income per year. That benefit phases out completely once you hit $150,000. But for real estate professionals, people who spend at least 750 hours a year on real estate activities, there's no cap. The losses are unlimited, and short-term rental operators on platforms like Airbnb have their own version of this through what's called the STR loophole. If your rental averages 7 days or less per stay, and you materially participate, meaning you're the one managing the property, the IRS treats that income as active, not passive, and you can offset it against your W-2 income directly. A doctor making $300,000 a year who runs a short-term rental on the side and does a cost segregation study could potentially create $60,000 to $80,000 in paper losses and reduce their taxable income by that amount. The W-2 employee sitting across the hall? No such luck. And then the new law did one more thing that benefits property owners directly. For years, there was a rule that capped how much you could deduct in state and local taxes. Things like property tax and state income tax. That cap was $10,000. Didn't matter if you paid $30,000 in property taxes, you could only deduct $10,000 of it. The One Big Beautiful Bill Act raised that cap to $40,000. For a landlord in a high-tax state like California or New York, where property taxes on a decent investment property could easily hit $15,000 to $25,000 a year, that change just freed up a massive additional deduction they couldn't access before. A W-2 employee renting an apartment? Zero property tax deductions, because you don't own anything. Okay, I know what some of you are thinking right now. Bro, I don't own any rental properties. I can barely afford rent. What's the point of knowing this? And look, I get it. I'm not here to sell you a $5,000 real estate course. I'm here to give you actual information. So here's what a regular person can realistically do with this right now. First, understand the advantage of REITs, real estate investment trusts. You can invest in real estate through the stock market with as little as $50. Platforms like Fidelity, Schwab, Vanguard, they all offer REIT index funds. You don't get all the same tax advantages as direct ownership, but you get exposure to real estate returns without needing a down payment. Second, if you're self-employed, even on the side, there is a version of depreciation and real estate deductions available to you if you use part of your home for business. This is a conversation to have with a CPA, but the door is open. Third, if you are seriously thinking about getting into real estate, understanding that the tax code heavily subsidizes ownership is a reason to take it seriously. The government has literally written the rules to make real estate investing more profitable. That's not a secret. That's tax law. And fourth, if you have a SALT deduction situation, meaning you itemize your taxes and you pay significant state and local taxes, the $40,000 cap change affects your 2026 return. Worth a conversation with your accountant right now. The gap between what landlords know and what regular employees know isn't about intelligence. It's about information. And that gap is exactly what this channel exists to close. Look, here's the reality. The tax code is not designed to be fair to everyone equally. It is designed to benefit people who own assets. Full stop. That's been true since 1921, and it is more true today in 2026 than it has been in a long time, thanks to a law most people have never even heard of. But knowing this changes how you think about money. It changes the questions you ask. It changes where you decide to put your next dollar. And that's exactly what we're going to keep doing on this channel. Next video, I'm going to break down the credit score system, how banks actually decide if you're worthy of money, and what most people are doing completely wrong that's costing them thousands of dollars a year in higher interest rates. If you're not subscribed yet, hit that button right now, because that video drops this week and you don't want to miss it. And if this video gave you something new, if it actually taught you something your employer never did, hit the like button. It takes 2 seconds and it helps more people find this content. I'll see you in the next one.